I just optimized the range at the point that I think is the best, or at least the best so far. I got 3 different set files for the algo to, in this case, close or try to close as low as possible to not manage to, let's say, to hold the full bearish move or the whole drop. That is at least $100. So some set files are managing to close. The standard is at 75. We managed to close from here from 600 to 575, and then I managed to get one at 60 and another one at, I think, 67. So just to make sure that, since I mainly tweak the inputs at the micro closing range, I want to make sure that it's not fitted for only for that range. So I go back to 2011, that it's the full range. Let me mark it at least very basic where it starts at where we are. The thing is right here. Okay, so 2011 will say it starts right here, and we finish more or less just roughly to know what area we are backtesting. So pretty much the 3 set files are being backtested with one logic. It's mainly grid and martingale what we're using with this code. So just to show what happens, you know. So I already did the backtest, and as you can see, this one set, this is another set file, and this is the third set file. Drop it here. Have very different results with the tree. This is the standard model I was using. I don't like this closing. It means I'm too slow at the time of closing. You can see it opens low levels. This is the main level at 47. Let's see where it starts. It's not that bad. It's managing to, for example, this logic or this EA is very good. It's very well suited for long term because we are not managing to, well, EA is not holding positions from these lows, so it means the retracement are very good and it's closing, but as you can see we have better set files. So I like this one. This is, let's check the proportion of risk reward. This is 2810. It is 1.55, not bad, versus retreats. Okay, this is 160. This is way better, so I'm rolling with this one. This looks better in chart, opens more trades, but per numbers this is the best one so far. So I'll keep testing this one. I'll test both for the whole range. I just need to do it in a separate model, but let's analyze this one. Getting 20k max drawdown in this range, that we know this is a very big trend, so that's amazing. Let's check the initial trades. We open some lots, some big lots. The trend starts. We mainly are chasing these retracements, so we don't have to chase the whole move and a big retracement, you know, like we can get out with small pieces of movements and the trend can continue, and we are not afraid because if we are exhausting the margin or closing trades, as far as the trend goes, if we are closing, we don't have any issue really. So let's see, where's the this is not the one. So mainly 2, 4, 6, 6, and this must be 1, 2, 3, 4, 5, 6, 7, 8. Yeah, 8 level. Okay, 4, 5, 2, 4. This is a big one. This might be the let's see, 0.01 order 85, 1848. This one, yeah, actually this logic is very good. So what I'm gonna do now is I'm gonna compare it versus this one, yeah, versus the one that has a better range or a better chart, but it's not closing better in numbers. Let's go to 2020. Let's see what happens, just to make sure both are running good, you know. Okay, so the tester just finished backtesting 2020 to 2021. So let me show you more or less where the range starts. I think is here or less. So we have this, it's kind of a big range. We remember, well, markets were not very stable at that point, like starting on the uncertainty on beginning of the year to the news of the lockdown on March. And well, after the lockdown announcement and all the consequences, people or investors or at least smart people started to hold gold at this point. That is 1468. So it's a very low price compared to the range we're trading nowadays. I mean, today we are at at least 280, 80 to 40 something, you know, too many too many drawings here, but we just wrote 2086. That was an all-time high actually here. So as we can see, we have a very big gap between liquidity at this point, what we had in 2011 and 2020 actually, because we only top at 2071 in 2021. It's a very big range, a very big trend. But as you can see, even here that we see very little retracements, the idea of the main logics is to do this, to distribute the equity among levels, among the trend. So as you can see, we're trading the range with all these small levels. And also to mention first, this on this side, you can see we're closing worse compared to this one. This is the one that it's performing best also in 2011 and 2013. So I'm staying with this set file. 4% win rate, only buying, remember. 8% drawdown or 10%, almost 11% return. So remember, again, this is only the main logic, so it's very solid. This closes a little bit less in range, or at least a little bit or less positive. As you can see, this has a very trendy to the upside balance or equity chart compared to this one that it's more stable. So that also means that is the reason that I'm pushing a little bit more the range, so I'm staying more time in trend. So far this will be the one that I'm keeping. Okay, we are rolling this time. We are throwing larger samples, we could say, or bigger pieces of data. This time I tested the last two set files. In this case was from 2004 to 2014, mainly all this yellow range, having this year or this cycle in 2011 as the major trend, plus a big retracement, and 2013 as the biggest single and unexpected drop. But I think it was either this one or 2020 for what I trade, but also this was a very big one. I stopped in 2014 because mainly from here, from 15 to 18, is 4 years, or I mean, sorry, 3 years, because, well, we could say also 2019, but price started to show some kind of bull pressure. So we could say at least from 2015 to 2018, we had big, good range. This is money making for Algos. Let me mark it for just for visual reference, we could say. It's here. So I mean, this is just money opportunities. It's a very small range. It's perfect for Algos actually, because every time it goes up, down, up. Okay, so you know, it doesn't matter. It's $339 range, but with a lot of retracements. So this is like, if you were trading this time with a decent code, you made a lot of money. So probably you are already retired by the time that COVID hit. So that's nice. But in this situation, let me show you the results. Again, we have this as the previous model, the one that acted as the last optimization, but I don't like this anymore. Just because of the, well, I haven't checked actually. This is going from, as mentioned, 24 to 2014. So let's see, we have 15 with 4 to 4, actually very similar round. So okay, actually, as you can see, I'm wrong this time. This is the good, we could say, just 1 second. Finish this. I'm just adding the ratios into my spreadsheet so I can have this is a very big difference. So as we can see, we're closing 118 here with a 37k max drawdown in a very large period. The chart itself is looking very good. If we remember, when I backtested at least 2011 and 2013, this set file that I have right here was giving better result. But on the long term, just the data shows like this is a very big difference. This is more than 20 and a little bit more than 20 we could say. So I'm now keeping this one as the main one. So it's important to do that. Backtesting is done. It takes a little bit when you test these whole ranges. This is a very big range. I'm in the weekly time frame, meaning every candle is 1 week. So this goes from 2004 to year to date, pretty much 2024 March. But I only backtested until here the beginning of 2024. So this is pretty much, let me also mark the range that I have trade live. So I have a little bit of let's see, 14 I deposit, say this one. In second, and I'll explain. Okay, so the blue square is pretty much the whole range that is worth testing in with xauusd. Is, as you can see, when the liquidity or at least markets started to be globalized, if we could say something, liquidity started to punch or to really reflect in the markets. The buying power of gold started to rise compared to all the money printed. This is the, let's mark 2008. More or less we're in this range. 2008, the crisis. A lot of people already know what happened in that time. I was very young, but I really find fascinating those situations where the economy really went south because of human mistakes, human greed. But basically, that's one of the main reasons I trade, or I use this type of strategies, because we are, even though markets are natural algorithms, humans are the ones that are at least making part of the huge moves. You can see here's the bull run for gold and all the swap and all the house market and all the issues with US debt crisis. I'm not trying to put a trend line here. I'm just showing the fact that when USD will take hits, this will happen. Price will go up, at least price of gold, and when price recovers, it will go down. So pretty much the back test is going bar by bar in the 15-minute testing exactly the price in this environment. As you can see, we have a lot of price action up and down. Even though we have here a trend, it's a wave. It's up and down, up and down. So what I'm looking every time is this type of retracements. Like here, all these retracements for me are money opportunities, or not money opportunities, because really you're not chasing the money, you're chasing safety. Like risk management should be priority for you in all these situations, because if you don't want to start the trend here and end up here and close around here, you will need to be chasing the micro retracements, because as you can see, at one point you'll be in a range for a long time. So also chasing those retracements will help you make money when market are ranging, because also it's very hard to adapt to make money either on range or with the trend, because I'm making a lot of money with this model. If price tank, a bit harder to push, because if I add up to the risk in this range, because I'm not making money, I don't do it here, but I'm starting to get desperate as a human here, and I say, okay, this is not working, this is too slow, market is ranging for years, now it's time to add up risk. So instead of balancing my risk for the 100% of a trend, of an economic crisis trend, I model, for example, this range that I already traded, that it's nothing comparable to here, right? So if I do that and then market just decided to start trending, I'm gonna end up losing that account, because I'm not well balanced to future situations. And as we can see what happened then, something that we cannot control, COVID, it was here. So pretty much what we need to do is to understand that risk can be controlled, just makes trading or investing a little bit slower. If you want, of course, to get more or higher returns, you will need to push the market. So those are the two scenarios that you should be focusing. If you're going to push the market, you're looking for, well, more or less trade probabilities or stuff like that. But in reality, you can make a model based on both, just using the higher time frames and the logic. You have a brain, so you will be able to figure out something the way I did, because I just view the market in one way. There's tons of ways to do it. So maybe you just need to find your edge or your way to view the market, so you can find that edge to start profiting. So let's go to the testing tool. You can see these two accounts just went through a very large period of testing. This is only the buy model. We continue just modeling this. Let's check these stats. We have 149k profit with 37k drawdown and 157k profit with 37k drawdown. So this is amazing. Again, we remember this, the account 575, one with 149k profit, was giving worse results by year, like 2013 and 2011 tested alone. This set file it wasn't good. It was better this one. Then I tested 2004 to 2014, and then this set file start to show more potential. And now that I run the complete spec, or what will happen in a 20-year run, well, this shows me that I'm better balanced with this set file. I open a little bit more trades. I have 2.2% extra win rate. That's actually very good. A little bit higher with the profit factor, and the absolute drawdown is a little bit lower, but not that much. It's very good. As you can see, what this main logic looks, it's, as we remember, only grid. It's anything you can do this, like anyone can do it. It's just grid and a simple martingale, one logic. This is the base of a sauce. So as you can see, this holds 20, like this period, 20 years period, with a 37% drawdown, just buying. Like, this is amazing. Like, this is not seems to be very basic, but it's also something that people can do. They don't seem to think this simple. They overcomplicate things, and that's why they don't get a simple base, simple sauce. So because from here you can do anything you want, you know, because you know you have the certainty or the facts that you will hold these big spikes. This is 2011, this is 2013, and this is 28. As you can see, for example, I'm looking at both of the set files. Here we have a very bad closing, even though we have one logic and martingale activated, or progressions activated. This is not closing good. Let's go to 2021. It was a very rough year. 2021 and 2022 are very rough years. Not everyone traded those times. This is the level that it's not closing good. It has a very bad average. Those are things that you need to manage based on, like, I can close here, for example, this has right now 30% average. If I put 40%, I will close, I will be positive. But if I go to, this is in 2021, but if I go to 2011, maybe that 40% is not working. So maybe this 30% with this specific set file is what makes it the overall drawdown low, you know, because I'm managing to exit faster. Let's see, for example, the biggest lot open, 0.56. That's in 2013. Okay, that's 2, 3, 4, 5, 16 levels. So that's pretty solid. If we remember, 2013 is being catalogized as one of the worst drops, or at least one of the most unexpected drops, because at least here you were expecting some recovery from USA par, or from the USA par, but here it was just 2 years after the debt crisis, and it went down. So it was a hit to gold. That's not very common for gold to receive hits. It's like saying they disappeared half the gold of the world, you know, and we have half of the existence and half of the gold that is missing to mine. So that will be a very terrible scenario for gold, and pretty much something that happened, but it's not something very common. You expect more news or bad news for the USD. So that's how the base of the sauce looks like. I really recommend you to do something very basic like this and start testing, modeling, see what happens when you start using different grids and multipliers with different market scenarios like this, because that's the way you will start understanding market. You don't have to put trend lines or start studying patterns or something like that. You first need to like just feel the markets, understand them in a way that you can test them by doing it, you know. Source codes or basic codes give you that, at least that opportunity to have an idea. As you can see, this is just grid and martingale, and it's trading better than 90% of the influencers and all of the FOMO that you see social media about perfect entries, probabilities, sniper entries, and all of that. That's not something they can model and show it to you like I can with the strategy tester. So it's just what it is. For example, if you go here, I know that I open a trade at 1331. 1331 is more or less, I think, here. So yeah, tell me if I open an order there and then it goes up and I close it at 1471 with an average of 1.56 in that lot going down, in the higher one there and going down. I mean, why I won't how to explain this? Why I won't believe the strategy tester if my strategy itself is very basic. Like, I could do it manually. I did it for months with Excel because I didn't have the code. So as soon as I had the code, it was very similar, but you just realize everything changes in matters of closings or openings. You will have some difference that you cannot detect by eye or just by trying to do it manually. You need the executions. That's why everyone fails when they go to live trading, either by emotions or because of the executions. I just recommend you to do this very basic. If you want any grid EA or you have some grid EA with martingale that can be backtested, let me know and let's check the EA and see what type of strategy and risk you're running currently with your accounts. But for now, let's leave it right here. It was a very good model. I'm gonna keep working with it. I need to add the side logics because I'm gonna show later how this looks without martingale. Pretty much I use 0.01 all the time with this logic. I'm just interested in knowing that it will close when I want or when I need, you know? So having a max 37% drawdown with this type of strategy that is not even the main one, I mean, you can be